Good afternoon, everybody. It appears as if some of your classmates decided to be thankful a little bit early, but I'm just thankful you all showed up. Okay, so today we want to talk about exchange rates some more. So most of what we did on Tuesday was to do a bunch of definitions, right, about things like nominal exchange rates or real exchange rates, appreciation and depreciation, and what all of those kinds of things might mean and how things move around in a floating or flexible exchange rate system. So today what we want to look at is how floating exchange rates fit into our aggregate supply and demand model, how fixed exchange rate systems work and what the implications are, and then to think about the kind of policy choices that different countries have to make, and then maybe try to make some assessment of whether flexible or fixed exchange rates are best, or under what conditions they're best. But let's start by thinking about exchange rates in terms of the aggregate supply and demand model. Now remember, we're talking about a short-run situation here, so we will continue to use a situation in which we're assuming that wages and prices are sticky. So whatever happens to the nominal exchange rate is also happening to the real exchange rate. Okay? So a nominal appreciation gives us a real appreciation, a nominal depreciation gives us a real depreciation. Now, what we saw last time is that when there is an appreciation of the currency, a number of things happen. Domestic goods that are exported have now become more expensive to foreigners. Right? Because of that, foreigners are going to buy fewer of them, and our exports will go down. If our currency appreciates, it also means that imported goods from abroad will be less expensive. We'll buy more of them, so imports go up. So we have an appreciation of currency, fewer exports, more imports, net exports. The difference between the two goes down. Okay? So notice here that up until this point, we've been treating the exchange rate as an exogenous variable. So this then becomes a negative aggregate demand shock. If the exchange rate appreciates, net exports goes down, planned expenditures go down, the IS curve and the AD curve will both shift to the left. A negative aggregate demand shock. Now, there's something else that happens here, and this is very peculiar, but it only happens with exchange rates. The price that we're paying for imported goods has gone down. If we import a lot, those lower prices mean more competition for domestic producers of similar items, or lower cost of inputs if the imports that we're using go into the production process. Either way, it suggests that the cost of production has fallen. So not only is an appreciation of the currency a negative aggregate demand shock, it is also a positive short-run aggregate supply shock. So the currency then gives us a shock on both sides, both on the aggregate demand side in a negative way and on a short-run aggregate supply curve in a positive way. Okay, so let's see what this means. Suppose for some reason the demand for the domestic currency denominated assets increases. The demand curve then shifts to the right, and the currency will appreciate. Okay, so that's just standard. Now, what we have to think about then is how we bring that back into our aggregate supply and demand model. Well, we've just argued that appreciation of the currency means that net exports go down. So a decline in net exports, a negative aggregate demand shock, will cause the aggregate demand curve to shift to the left. At the same time, the price of imports has also gone down. And this is a positive short-run aggregate supply shock. So the short-run aggregate supply curve also shifts down. Now notice that this price shock comes about not because of a change in inflation expectations, not because of a change in the output gap, but rather simply a direct change in prices, unrelated to either the output gap or the unemployment gap. Okay? So this would be kind of that part of that row term that changes. Remember our row term at the end of our equation for the short-run aggregate supply curve? So this is a price shock that's taking place. And notice where we end up. We end up right here, where economic output has declined from Y0 to Y1, and inflation has declined from pi naught to pi 1. So both of those things are happening. Notice that the positive the positive short-run aggregate supply shock pushes inflation lower than it would be otherwise, but it also helps to restrain or limit the downside, the decrease in economic output. Okay? Positive supply shocks reduce the short-run aggregate supply curve, lower inflation, lower interest rates. I'm glad you asked that question, because I was just going to mention that. So the question was, is it possible for the short-run aggregate supply curve to shift down so much that economic output would actually be higher? Clearly we could draw it that way, but you will never find an example of that in the real world. The key when we're dealing with this is to keep in mind the aggregate demand shock is substantially larger than the short-run aggregate supply shock. So the effect on economic output will be determined by the aggregate demand shock, always. In general, that short-run aggregate supply shock is actually fairly small for a couple of reasons. One is, for most countries, imports are not a significant portion of overall economic activity. Second, even in those countries where imports are a significant portion of overall economic activity, most international trade is denominated in either dollars or in euros amongst the euro countries. So there's no exchange rate effect for the U.S. when everything's done in dollar terms, no exchange rate effect in euro terms for the euro countries. So, and a third reason is that most international trade is done on longer-term contracts. So the price is already set in. So it's already priced in, so whatever happens to the exchange rate generally doesn't have a significant effect in the short run. Yes? Because the shift, so the question was, why does the downward shift in the short-run aggregate supply curve still have expected inflation at pi naught? The shift here was not caused by a change in expected inflation. The shift was caused by a change in the row term, the price shock term in the equation. So in the year of the shock, in this case in the year of the currency appreciation, expected inflation has not changed. Remember, in our adaptive expectation formulation, expected inflation changes the following year. Okay, so that's how we want to think about what happens to aggregate demand and aggregate supply when the exchange rate changes. So what we just saw then, an appreciation of the currency reduces net exports, which reduces economic activity. And it also reduces inflation because of the short-run aggregate supply shock. Now, what causes the exchange rate to change? If you remember our uncovered interest parity condition from Tuesday's discussion, we saw that the current exchange rate is basically a function of three variables: the real domestic exchange rate, the real foreign exchange rate, and the expected future exchange rate. So remember, we're talking about the demand and the supply of currency-denominated assets. The real exchange rates, both domestic and foreign, are telling us what we think the rate of return is on domestic assets and foreign assets. The expected future exchange rate also tells us how much appreciation or depreciation we expect in the currency over time. The greater that is, the more we want that currency. Wanting that currency today is going to cause it to change as well, in this case, appreciate. Okay? So let's think about how this might work in a full-blown exam-type question, or maybe a problem-set-type question, or maybe in the real-world type situation. Okay, so here we have a situation where we're in equilibrium at point A. Now, let's suppose, notice this is our aggregate supply and demand model. We'll just assume point A is a general equilibrium, so we don't have to worry about changes in inflation expectations here. Let's suppose that in this country, whatever it is, there was a huge increase in the stock market. Right? So the stock market goes way up, up and up and up and up and up. All the residents are walking around feeling pretty wealthy, right? Because their stock portfolios have now increased in value. So they're walking around and saying, wow, I'm feeling really good about this. What happens? Autonomous consumption goes up, right? If I feel wealthier, even though my income has not changed, I'm going to increase my spending. After all, one of the reasons I save is to achieve a certain wealth level. If I get there sooner, now I can spend more because I don't need to save as much in order to achieve that goal. So if the stock market booms off, then we see autonomous consumption increase. So when autonomous consumption increases, the aggregate demand curve will shift to the right. Now it's going to turn out this is going to be an intermediate step. So I'm going to label this AD1A. And in our analysis that we've done up until now, we would see that economic output would rise to Y1A, and inflation would increase to pi 1A. And at this point, let's just call that point B. So up until this point, that's exactly where we would stop, right? Everything would be, we'd all be happy. That's what happens when you have a wealth effect. But what happens when inflation goes up? What else happens? The real interest rate goes up. So now the real interest rate has gone up. What's going to happen to the demand for dollar-denominated assets? So notice the domestic real interest rate has risen. The rate of return on dollar-denominated assets has increased. Everybody will want more dollar-denominated assets in their portfolio. The demand for dollars will increase, leading to an appreciation of the currency. So notice then that the positive aggregate demand shock leads to an appreciation of the currency because it causes higher real interest rates. What happens because of the higher exchange rate? What do we know about the price of American exports to foreigners? It goes up, right? So foreigners buy fewer of them, exports go down. The price of imports goes down to Americans, so we buy more of them, and imports go up. We now have a negative aggregate demand shock. Now, although this happens in the same year, I'm going to change colors just to highlight what's going on. That negative aggregate demand shock means that the aggregate demand curve actually shifts back to the left a bit. It's only partially that it shifts back. But we have to remember that appreciation of the currency is also a positive short-run aggregate supply shock. So notice then that the appreciation of the currency limits the increase in economic output. The appreciation of the currency also limits the increase in inflation. Economic output will definitely increase, as will inflation. I realize you could draw the curve, so that wouldn't be true, but when we look at the real world, this is what we see. Economic output will definitely increase. That is, the domestic effects of this increase in autonomous consumption is greater than the negative effects from the decline in net exports. The positive aggregate demand shock pushes inflation up by more than the appreciation of the currency causes a positive price shock. So we end up with higher economic output and higher inflation, just as we would expect without thinking about exchange rates, but the increase in economic output and the increase in inflation are not as big. They're not as big in an open economy as they would be in a closed economy, an economy with no net exports. Now, analytically, we can stop right here. Now, you probably noticed, well, gee, inflation came down a little bit. Doesn't that mean interest rates came down a little bit? Doesn't that mean the exchange rate comes down a little bit? And if you want to draw all 15 intermediate steps until we get to the final solution, talk to your GSI because they'll tear up your paper. We don't need to do that, right? What we're really interested in at this point is where do we end up? But we want to think about this as a two-step procedure. What happens in the aggregate supply and demand equation? How does that translate to the exchange rate? Once we know how that happens to the exchange rate, how do we show a small offset in our aggregate supply and demand model? This will make it very clear exactly what's happening when the exchange rate appreciates or depreciates. So we want to always be using these two diagrams together, generally side by side, sometimes top and bottom, sometimes different page. No, side by. So we'll use them together. Shocks in aggregate demand supply space cause something to happen in the exchange rate space, bring that back and see what happens. So remember, we can also have exogenous shocks to the exchange rate. When we're only looking at whatever country this is, the foreign country is exogenous to us. But if they have an aggregate demand shock, their interest rate will change. That will cause the demand for our currency to change, which will then have an effect on our economy. Right? Or if there were, for some reason, a change in the expected future exchange rate, that would also cause changes in the current value of the exchange rate. But that change in the expected future exchange rate would be an exogenous variable. Right? We don't have anything to explain what's causing that to happen. So if there's something in the domestic economy that happens, we start here, we go to the exchange rate, and then we come back. If it's something that starts in the foreign exchange market, here, we show it there, we come over here, we're done. Right? Easy peasy. Those are technical economic terms to mean easy peasy. Okay, so that's how we can deal then with flexible exchange rates and show what they need to, how they will affect domestic economic activity. So let's spend a little time talking about fixed exchange rates. Now, it turns out that fixed exchange rates currently are not terribly important because, by and large, most countries don't have fixed exchange rates. There are very, very few exceptions to that. Historically, however, many countries had fixed exchange rates. And in order to fix an exchange rate, you need to fix it to something. Right? You need to fix it to something. It used to be that what we fixed exchange rates to were commodities, particularly gold. I'm sure you've heard of the gold standard, right? Or silver or any other sort of fairly rare commodity can work. Right? We want fairly rare because you want the money supply to be relatively limited. Right? Too much money, too much inflation. So we want some sort of fairly rare commodity that we'll be dealing with. Okay? Now, people don't use commodity standards anymore. Rather, they fix a currency to another country's currency. The currency that it's being fixed to is referred to as the anchor currency or the anchor country. And usually, if you're going to fix your exchange rate, you want to fix it to a country that has a stable political system and a commitment to low inflation. So historically, the anchor currencies have been the US dollar, the British pound, the French franc, the German Deutschmark, and currently the euro. That's basically it. There are a few other weird arrangements in there, but they really weren't done very well. So those five. And in most cases, for the French franc in particular, it was only with their former colonies. Once they gained their independence, they had a particular relationship with France. They would fix their currencies to the French franc. Of course, the French franc and the German Deutschmark don't exist anymore, so they've been replaced by the euro. So that's basically what you have to do. Now, when the fixing takes place, it is the government that makes that decision. Right? The government makes the decision that we want to fix our currency to something else, whatever that anchor currency will be. The way in which that fixed exchange rate is maintained is that the central bank says we will buy or sell, depending upon which way the pressure is, any amount of our own currency that the market wants at that particular price, that fixed exchange rate. In other words, the country's central bank steps in and buys and sells its own domestic currency to keep the fixed exchange rate. Notice what I didn't say. The anchor country's central bank has no obligation in this arrangement. The anchor country's central bank has no obligation in the fixing of the exchange rate. So we see some exchange rates that are fixed. At one time, Argentina had a fixed exchange rate with the United States. It does no longer. That was a decision of the Argentine government. They didn't have to ask permission of the U.S. government. And the U.S. government, neither the U.S. government nor the Federal Reserve had any obligation to try to maintain that fixed exchange rate. Right? Did not have to enter into it at all. So sometimes when one sets up a fixed exchange rate, one of the things that's really required in order to sustain that exchange rate is your credibility that, in fact, the central bank will make those interventions, buying and selling, so that they can actually make that exchange rate fixed. In order to improve the central bank's credibility and of its commitment to the fixed exchange rate, countries sometimes, not always, but sometimes set up what is known as a currency board. And basically what a currency board does is to buy enough of, or acquire enough of the anchor currency to completely replace the domestic money supply. To completely replace the domestic money supply. Notice if they have that, the exchange rate that's fixed can be maintained. Right? We can always simply replace our domestic money supply with the